Hello, ladies and gentlemen, and welcome back to a special weekend edition of the markets around the world. Well, what a week we just saw. Over $2 trillion of options expiration, leading to the market pulling back down to what we thought, a maximum pain style scenario. We also had markets recovering back to the all-important 200 SMA. We've got some correlations in today's video with when that's happened in bear markets before and what's happened after that. And on top of that, we also had a thrust rally in the recent weeks that's led us to really start to question whether we did just see the dips. So in today's video, we discuss everything to do with the markets moving forward, on top of whether we're going to get a shallow pullback here with the thrust or a further pullback down to the lows. There's so much to discuss and some great charts ahead. So I'm pretty excited to show each and every one of you right now all of this stuff. See you soon. Well, welcome back everybody to the Daily Show where we talk about markets around the world. We've got a whole bunch of charts and really key levels to be looking at today, but let's begin by discussing the bull case and the bear case right now. And we've got some great data for this. Now, I brought up a bunch of correlations here, and what I think is the most key thing about this is notice all these scenarios. Not only are they 80% correlated, but in every case, even the bull cases, we generally get a dip that comes down fairly significantly, and then we get the turnaround. Or of course we get a dip followed by a new low. Look at these correlations. All of these charts, they all kind of turn at this point. You'll see why when we go through today's video a little bit more. Now this is in line with all of our data. We discussed this about a week ago. We said we were right at that peak and we were looking towards at least having this pullback. In cases that went really bullish and there was no recession, we tended to go super bull here. Where there was a recession later on, we tended to pull back to the lows, if not make new lows. Interesting thing about recessions is we don't even know what that means anymore because of course the government's changing what it means all the time. But more importantly, we've now seen over 50% of all yield curves inverting. And for anyone that doesn't know, that's been basically 100% accurate in calling recessions really over 70 years. So we'll share that later on in today's video so you can have a look at it. What about rejections on the 200-day moving average? Well, of course, this is where we were previously, and it's what really led us into that kind of bearish mindset. We saw it in the price action, we saw the turnaround, and it led us to being able to really discuss the idea that the market was coming down. In previous cases, such as, of course, the 2000 crash and the 2008 crash, we saw it lead on to much worse situations. Of course, we don't know that yet, but we can put it in the charts. What we do know, based on data around these points though, is that when the 200 rejects, it generally leads on to choppy kangaroo style market returns. Look at these percentages down here. Pause the video if you need to. Usually that next 3 months into 6 months can be a very tumultuous time and really suit probably more the day trader and the scalper than necessarily the swing trader and the investor. And that's just because we're in an uncertain time with a whole bunch of different things going through. But of course, that's the bear case. The bear case really is either a new low or potentially a dip down to the lows with maybe a pullback at this case. What about the bulls? What are the bulls thinking? Well, this is where breadth and thrust come into it. And thrust signals together with breadth are quite accurate. Here we can see that we're just approaching and going past the 50% thrust threshold. And this is a very important level. If you've noticed it in the past, what's happened is it's tended to lead on to 93% over 1 year cases, the market being bullish past that point. 6 months, 90%, and 3 months is 90%. So a pretty big statistic there. What about when we bring thrust together with breadth? Well, here's momentum thrust without breadth. Look at the signals it gave. Here's momentum thrust with breadth. And of course, this is why so many bulls are so excited about this market, because they're looking at it purely from the data perspective. And they're saying, look, guys, whenever we see those indications, we usually are getting the bottom and it's by the dip style scenario. Of course, you could go with this. There's absolutely key data and key statistics around it, but it's certainly very interesting. Another one that you may want to see is SPY breadth go past the 200-day moving average in terms of the recovery. Usually when that goes above 60, it's a very good signal that the low is not only in, but at the same time, the dips will be purchased by the street. And we haven't quite seen that one yet. So what are another bull case scenario? Well, I think the biggest bull case really right now is just the ridiculous amount of bears in the market. It is a crowded trade. Here is the net speculative position between minis and other investments out there. And you'll notice the percentage open interest of the bears is higher than any other time in the recorded history that we have here. That's kind of annoying for if you're trying to be a bear in this market. It's still a crowded trade towards the bear side, and it has been all the way through this rally. I've actually got some data here coming through from the SP500, and you'll notice that the leverage traders, that is usually the hedge funds, continue to just short and short and short this market. Every single time it pretty much goes up versus, of course, the asset managers, which are starting to purchase back in. Now, who do we trust? Well, I'll let you know that in the history of what I've looked at, sometimes leverage managers do get it wrong. Generally, we'll get a big flick though, where they'll just completely reduce their position. We'll usually get a dip followed by a massive reduction from the leverage traders. That's what happened in 2020. If that happens again, of course, subscribe to the channel. I'll let you guys know, because that could be a good lead indicator that they've got to bail because they just got squeezed out of the market, and the market generally continues up from that point. Here's the Nasdaq in terms of what's going on. Of course, leverage traders starting to short heavier on the Nasdaq, asset managers purchasing in at a faster rate than they have been during 2022. Both key charts just shows you how crowded though this trade of shorts is. Midterm election years for VIX traders, as we know, we're heading into the midterm election. I brought this chart up a lot. It leads into this idea that there's going to be a bit of volatility moving forward. This is the volatility you generally see August, September into the middle of October during presidential cycle year twos, and of course the midterm elections in the US. It's a super important time. For fundamental traders, really what you guys are looking at is, well, is the stock cheap over my time horizon? Whether your horizon is 2 years, 5 years, 10 years. Remember, investing and trading are different. You've got to look at it from this perspective. Of course, forward PEs at the moment, we're looking at S&P 500 large caps, 18.1, mid caps and small caps, however, have both been bashed down to levels that are really in line with almost historical lows from the data we have here. Obviously, you go back previous to the 90s, you're going to get much cheaper prices on the S&P 500. But over the last 2 decades, what we've generally seen is this being an interesting price for some of those stocks. And I think a lot of you would see that when you load up your hyper stocks on the markets, etc. What's Wall Street doing right now though? Well, they keep going into the defensive sectors. We've seen staples and utilities and healthcare being some of the best performers over the last couple of days in trade. And what that led us into believing was the market was going to drop. And of course, it all coincided together. And what did we get? Bam, the market came down. So we're seeing staples still holding well. As long as they're holding well, it usually means there's more to come. If we start seeing rotation back into things like technology and back into clean energy and gold and all these other things, then we've got to start to, of course, correlate and work that out together. What about the VIX? Let's get into the charts now. The volatility index has not really gone up much. In fact, it's still floating around 20. So if we do see a major sell-off, we'd expect the VIX to go up back to, a 25 or even a 30 level. At the moment, it's sitting in basically neutral territory between a bull and a bear style market. We're almost at equilibrium in these markets. What about yields? Yields continue to rise here on the 10-year, and that's something that's kind of interesting about this market. It could be that yields get back up to like 3.15 on the 10-year. 2-year also rose a bit, 3.238. Remember, if both of these break out, especially the 2-year, it's very correlated with the S&P 500. So if the 2-year continues to spike and the stock market's not moving down and it continues to go up, eventually you'll see the stock market usually turn over. It doesn't like the 2-year going up for too long. And at this stage, it's at a pivotal point ahead of course, the Jackson Hole Symposium coming this week, and we'll talk about that later in today's video. US dollar continues to rise. This is much in line with all the key factors that we've figured out. We really started talking about a bullish down here, obviously remain bullish in this area, and it's hit really all the targets at this stage and just getting into that final target zone. Past that point, if we get a new high, of course, the US dollar could continue to be a very strong trade, but it's starting to get pretty extended. This is a lot of bullish days here with a huge amount of strength in the US dollar. The way I'm really looking at this is actually a correlation with gold. And why I say that is because we obviously knew that gold was extended. Money flow is flowing back into gold though. So gold, while a lot of people are probably starting to turn bearish on it again, this is everything that we'd hoped for all this trade so far. We got back up to this key level. We saw it reject that range there, which was really fantastic. Support becomes resistance, a whole bunch of supply kind of levels that are going in here. And now we've moved down. Now we just broke underneath the 1755, which is one of our little defended zones. So this week coming, could we move down to a 1720, 1715 gold? Somewhere in there, you'd expect buyers to come back in. Again, a thrust in the US dollar, a downtick in gold, then the US dollar turns over near the high, and of course gold would hopefully go up at that point. So a very interesting synergy coming with gold and the US dollar this week. What about US oil? It's actually looking a little bit bullish. You'll notice here that it broke through that previous resistance, pulled back as we suspected it would in the previous session, and then we rallied through. I'd like to see further rallies going this week. If it's going to find buyers, it really needs to rally here. Notice the close on the daily. We had the high, the low, the open, the close. That's a long leg doji. Equilibrium, or of course some form of indecision happening here on oil. I'd like to see buyers come back in, push it towards 95. And at that point, we're going to find out whether there's really commitment towards the oil trade. Because if they buy through there, we've basically created a base that can then be purchased back up to maybe even as high as 105 a barrel. So I'm not so negative on oil here as of the current price action that we've seen. We'll find out whether it can hold through. Another reason I'm not too negative on oil at this stage in the short term has to be to do with copper. Copper actually swung the lows on the Friday session and Thursday sessions, and this was the big deal. It went underneath, taking out the stop losses that would have been here and grabbing liquidity towards a fairly decent move up. It looks like a lot of these precious metals are still in rotation at this stage. And have a look at the daily here. We have lots of rejections coming off this zone, huge amounts of buying, clearly some form of demand. That's important. And that pushes copper into the idea of getting back to like a 380 here for this metal. And of course, pushes the idea that a lot of metals could be on the uptick, even though that's certainly not the trade that the media would make you believe is possible. Move over to Tesla. What's going on there? Well, Tesla's in the middle of nowhere land. If we put a volume profile on this, which we will do, so let's chuck one on ourselves, and we'll just do it over the previous kind of history. You'll notice that it broke underneath, which was in line with what we discussed. It's then come to the second biggest volume profile level, which is around where it is right now, 890. Support for Tesla is around 840, 850. We also have a 200 1 hour sitting behind that. Not sure if that's such a good dynamic support level, but certainly coincides with it. So we've got an 840, 850 kind of support this week for Tesla. We have a gap that's sitting in here around 900. Should the stock market rally, there could be sellers that get committed back into this trade somewhere around 910 or even 920 for Tesla. And I like it down here, and obviously I like it on the breakout should that occur over the next couple of weeks. We'll discuss that soon. A lot of people discussing Apple, and Apple is one that just broke to the low. Finally, Apple found a negative day, down 1.51%. Now, I think almost everyone's talking about this chart. It's up well over 35-ish%, I think, or around that percentage from the lows. Apple moved all the way to 176. This was the last trough for this particular stock. So does it now break through and continue to move down to fill some of the gaps that it left behind? I think it's a kind of likely scenario. And this is the first weakness we've seen in Apple's chart for a long time. I mean, it's been a while, guys. Apple does not show weakness very often. Notice the volume profile I've got up here showing that this is the key kind of equilibrium level that a lot of orders got put through on, 165. Now, if Apple gets down to 165, that's going to, of course, tank the Nasdaq and the SP500, and we'll look at where we believe the market will be at should this occur. So Apple's first sign of weakness certainly showing up here in the charts. The DAX was everything that we really hoped it would be. Here's the downward trend line that we've discussed now for the last couple of sessions. The DAX moving down. certainly in line with everything we're thinking about. And if the S&P 500 continues to weaken, so should the DAX. Key levels here will be around this 13,400 zone and also 13,100. They're the key levels for the week ahead for the bear side. IWM versus the Russell 2000. Here is a good idea of where the bulls really get control. Generally speaking, if you go through this chart as a correlation over time and you look at when the IWM recovers with the Russell itself, so this is the Russell going against the S&P 500, often when it starts to break out and has these thrusts in it, that usually ends the bearish market. So this is another good indicator to have on your charts, and we'll be watching that. We're looking for a ratio above 0.47. We certainly haven't seen that yet. It's come up to a resistance that in previous times has caused, of course, the market to turn around. Back in March, we got it where, of course, what happened first? The Russell led the decline. In this case, is the Russell leading the decline? Let's have a look here at the actual Russell itself. Notice the pullback that occurred on this chart here, quite significant, and certainly a bigger pullback than we're getting in some of the other markets. And this makes sense because, of course, small caps should lose more value than large caps if the market gets freaked out. Look at that downward trend line. That's now out. Even this one here, if you're drawing that, again, a breakout down below. Weakness coming in here to the small cap companies. Move over to Nasdaq. Nasdaq into its gap range. Take a look at this. We've still got a lot of work to do before we get down to closing into the gap. The gap's sitting around 13,000. As of the time of this recording, Nasdaq's sitting around 13,242, but it did leave a gap behind as well, which opens it up to all sorts of manipulation this week. This is where options are going to come into our analysis quite a lot. So still further downside absolute potential here for the Nasdaq, but we'll use the S&P 500 to figure it out. Let's go over to the S&P 500 now. So we have the 200 SMA, we have the long leg dojis, we have obviously the gap that's down here, and we know that it came back to a big Fibonacci, that's 67 on the fib, which was the average pullback size of all bearish markets into the 200. It's how we correlated so many things together to point towards that being where the turning point was going to happen. Now let's look at the smaller cap size. On the smaller size, we have a gap to fill at 42.84, one at 42.07, and one at 41.23. So we have two real major scenarios this week. We have the scenario where we come down, most likely to fill the 42.07. That probably seems quite likely for it to do. And then do we bounce and go back to try to fill this one here, the 42.84, or are we going to bounce and then sell straight through to 41.23? Well, this is where the options will hopefully help us out as we go through and navigate this week. But basically, these are the key zones. 41.23 is going to be a strong buy level, you would think, for the street. They're going to like this zone, and it's going to be in line with a nice, pretty much consistent kind of pullback, about 4 and a bit % in terms of the pullback from the highs. And this is a standard type of pullback that you get before usually you can see rallies. So 41.23 gap, 42.07 seems very likely. And the current trend is certainly towards the downside. We saw peak, trough, higher peak, lower trough, pullbacks met by sell demand in line with what we thought. And now we'd like to see lower peaks and lower troughs into 41.23. Certainly something we're angling for this week. Be careful of the 4200 zone. That's going to be a big one. Let's now look at the options expirations. This is the Monday expiration. Quite a few of you must have turned bearish because that's a big max pain coming through. Where are our call kind of strikes? So we've got a 430 on the calls. So it's unlikely we get past that level by the close of the Monday session. That's in line with, of course, filling that upward gap. We've also got 425s, which would be kind of the perfect level for the market to close. And we have a lot of 420 puts loading in. So let's say we go bearish in the morning during the hour of power. What's retail traders going to do? Probably going to load 420 puts. Now, if they do that, this will go out of control. And what's Wall Street's best profitable action? Keeping it above that price. So we'll have to watch that throughout the session. It's certainly going to be important. Let's move over to the Wednesday chain. What's going on there? Well, Wednesday chain drops a bit, 415 and 413. So this allows more of our system to potentially play out, which is the concept of bouncing off 4,200 into a potential drop down to fill that 41.23 gap. Could that happen by Wednesday? It's possible. Of course, that's when we see Powell, I believe, talking. And then we go into the Friday here, and then we've got a max pain sitting at 420 with a huge amount of calls and puts sitting at about 415. Again, it's in line with maybe a pullback this week, but it's not really showing us that the end of the market is going to occur and the whole thing is open to huge shorting. Of course, we'll keep an open mind, but this is where we sit with the options this week. Move over to Bitcoin. What's going on there? It's kind of sitting on support. So basically, Bitcoin dropped off a cliff. I certainly haven't been loving Bitcoin recently. I just think the charts have looked pretty poor, but we're back at a support. It fell straight into those zones, and a lot of it's got to do with also what's happening in the stock market. So if the stock market falls further, Bitcoin could seriously fall down to 19,000. And if that happens, then of course we could move even further down, potentially if we get underneath that. So just be careful here on crypto. It's still in the winter, and that is the crypto winter, and we'll find out whether it can hold up. The most surprising move though was Ethereum. We talked about that 1700 zone. And if we go down to like a 2-hour chart, there was no buying. It just fell off. This is why you want to react to the movements. You find an area and you find a turnaround concept in that area. Should you see that, then you can really instigate some kind of buying potential. At this stage, we haven't got really any strong support here for Ethereum yet, and the market could pull back even as much as possibly all of its kind of like a fib retracement or something like that. So if you took this run, you could be looking at possibly like a 1,370 or 50 here for Ethereum before it finds true support. Same or similar with Bitcoin, 20,000 would probably be around the same price if that was to occur. So be careful on these markets. It's going to be a little bit, I guess, dodgy out there. Now, we said before, come follow us at FX Evolution on Twitter, but also we shared this chart here last week, which was 50% plus of yields inverting. That's always precursor to recessions, whatever they're called nowadays. And yeah, it kind of points to that scenario more that we showed at the start of the video, where with a recession, we usually got a secondary dip in the markets. That was a dip that came down further. So it's going to be a very interesting 2 months here, because the thrust and the breadth point towards a new bull market coming through. But of course, the data and the statistics and everything else also points towards the dip coming before anything else. So it's going to be a very big time here in markets and super exciting. Make sure you follow the channel. We'll be following it all together. Let's look at this for the news ahead. We've got Flash Services PMI here, Tuesday, August 23rd. And then if we scroll down, we've got the Jackson Hole Symposium with the AAPL coming out, as well as Core PCE Price Index on Friday. Thanks so much for watching the videos. If you do enjoy them, make sure to subscribe, smash that like button, guys, and we'll see you in the new week, really with some exciting stuff, because I think this week's going to be another one of those doozies. Keep safe out there, and best of luck. See you soon.